All right, everyone. Welcome back to the weekly roundup edition of On the Margin. I'm your co-host, Michael Ippolito, and I am joined, as always, by my great-hearted co-host, Mr. Tyler Neville. What's going on, Tyler?
I feel like I need to give you some Prozac or something with that. Jesus. What's going on in New York?
It's weird, man. New York is opening back up. I don't know if you saw it. Yeah, they've got a full open plan on July 1st. So
nice. There we go.
I know.
Yeah, Texas has been open for, I don't know, a couple months now.
Did it ever close?
No.
All right, guys, we've actually got a great show for you today. We're going to be talking about the 4-week rates on U.S. bills having turned negative for the first time since March of 2020. We're going to be talking about the Nexon purchase of $100 million in Bitcoin. Germany has been opening up its institutional Spezialfonds to crypto. I don't know if I said that correctly. And then we're just going to end with some general thoughts on the run that ETH is on right now, which has been pretty exciting to watch. Before we get into the actual content, Tyler, how's the week been, man? What have you been up to?
It's been good. It's been good. I can't complain. My kid started daycare again, so he's
Nice.
out of the house twice a week.
Wow.
And,
What are you doing with all that free time that you have?
Well,
Must
I
feel
don't
like a
know.
luxury.
That's 1 year old, so it's yeah. But the screaming and yelling has dissipated, so I can actually hear my own thoughts now.
What a luxury. What a
But
luxury.
yeah, how about you?
Nice.
What's going on up there?
What's going on? I don't know. Nothing really. Like I said, I mean, it's starting to feel like it's opening back up. Like Williamsburg is getting busier, let's call it.
Nice.
But yeah, I'm excited to start spending $18 on a cocktail and sit out on a bench instead of sitting in my home and drinking.
That's awesome.
Yeah, it's gonna be a real change in my life.
Are you going for the Steve Jobs look? Is that like a black turtleneck?
All right. I gotta get rid of this. You know, I love this. I love this shirt. I can't wear it because every time I do, that is the response that I get. So I love this. This was a gift. I will say it was a gift. You know, I didn't go out and say, "Hey, I think I would look good in it," but I've worn it one too many times here.
I love it.
And I'm out. All right. With that little fashion criticism, let's actually get into the stories here. Let's enough small talk. All right, so we're going to be talking about negative rates on U.S. bills. So rates fell to -1 basis point, the lowest they've been since March of 2020. It's obviously not super negative, but it is still worth saying that rates on U.S. debt are actually yielding a negative return. There's been a lot of demand for short-term money, but yields further out on the curve are actually rising in contrast to this. So if you look at the 10-year, that's actually risen to 1.65%. That's up about 10 basis points from, I guess, the local bottom, you would call it, which came in about a couple weeks ago. So Tyler, what's kind of happening here? What's your take on all this?
I mean, I think what's really happening is the Fed kind of realized they were disintermediating their banking system by keeping, the yield curve so flat. And if you look at basically, the steepness of the curve is going up, and the front end is really cheap and the back end is getting steeper, and it's helping a lot of financial companies. Like if you look at the KBE or Wells Fargo stock, like it's been on fire lately. So I think the Fed is trying to mess with the yield curve so that it helps some of the companies it was hurting for a while. That's sort of what I think is going on. But also you have, the back end of the curve has a lot of, they're trying to move up the issuance from the Fed because of the deficits blowing out to the front end of the curve because there's more demand there now. But we'll see how it shakes out. There's some funny stuff going on. Like, I don't know if you caught the TLT. I think 25% of the TLT is held short now. So the bond vigilantes are coming out at the longer end of the curve as well. So there's lots of different dynamics going on. But I still don't think that changes the longer term, that there is so much U.S. Treasury supply coming down the pipe that yields will rise on the longer end for the foreseeable future.
Yeah. I gotta admit, like, I'm probably gonna betray my own ignorance here. I was surprised to see this, actually. I realized that that's super short-term debt, but I didn't realize that actually U.S. issued paper has gone negative. So I was kind of just surprised to see this in general, to be honest.
Kind of crazy.
Yeah.
There's so many conflicting things going on. Like, we're in like a bull market in fear, so that keeps like cash balances really high and like savings rates. I don't know if you caught that number. It's just like
Yep.
skyrocketed. And so people are, hodling money in at the front end and then going super risky on the back end. It's kind of nuts. It's a weird dichotomy.
It is a weird dichotomy. Yeah. So, I mean, you said that the Fed was kind of trying to shift, into shorter term debt. Basically, is that basically like a? Other people were there was a lot of talk earlier about like an Operation Twist type thing. Is that what we're seeing right now? It's just not being called by that name.
I don't know, honestly. I just think that they basically were letting the long end of the curve go up too far too fast, which caused like kind of a bursting in the duration bubble. And we saw like all the super high fast growth stocks kind of roll over. And I think if you move up the treasury issuance to the front end of the curve where there is more demand, it's probably like you keep the whole game going a little bit faster. But I guess if there's more demand there, there's less, I guess, friction than bursting the duration bubble on the back end. But we should talk to a bond guru on that, treasury guy.
We should talk to a bond guru. We got. I mean, we've got Greg Foss coming on the podcast in a couple of weeks.
Oh yeah.
I mean, you and I have talked about this. You turned me on to this episode. I think it's the best podcast episode of the year. The interview that he did with Preston Pish. Just phenomenal. So good. Yeah. So many nuggets in there. Talking to a guy like him, I mean, his knowledge of just high finance and markets in general as an ex-high yield bond trader is pretty unrivaled. And he kind of took a lot of that knowledge and synthesized it with what's going on in digital assets and Bitcoin, produced some really unique results. But, one of the things that he mentioned that I really had to run to my dictionary for was you just talking about bond math and convexity. And you just mentioned the TLT, is down year to date, like, what is it, 12%, something like that? So
Yeah,
can you describe a little bit about the convexity that's kind of buried in bonds? Like, describe what that concept is for people, and then why are we looking at, like, how has that ETF dropped as much as it has?
yeah. Just the longer you go out on the curve, essentially, the more sensitive the price of the underlying asset is when rates actually move up. So if take housing, for instance, it's basically like a bond proxy. And as mortgage rates move lower on the longer end, because it's a 30-year mortgage, you can buy way more house with it. So your mortgage shrinks, the payment shrinks as rates come down. Now, as rates move up just a tiny bit, it becomes even more sensitive, and then your price drops like exponentially lower. So like, I think even Greg Foss says this in the interview, but like if rates go up 100 basis points, that causes a 20% fall in the price of the bond. Similar to housing, you think about it the same way. Your mortgage payment grows exponentially as that 100 basis points goes up. So it's just a sensitivity gauge on the underlying price of the asset.
That seems really problematic, honestly, because, there's been a lot of talk recently about how we might be at the end of the 40-year bull market for bonds. But still, if you look at where institutional investors have the majority of their portfolio, there's a lot of talk the death of 60/40. There's still a lot of big investors out there who hold bonds. And actually, I mean, I'd love to get your take on this because you shared this great chart with me looking at corporate pensions, and their share of fixed income securities has actually continued to rise and is now at over 58%, the highest it's ever been, at least in the last 15 years. I mean, how do you reconcile that with rates as low as they have? It looks like there's no more capital appreciation left in bonds.
Yeah, I don't know what the decision making there is, to be honest, because I think a lot of the public pensions are moving out to like alternative assets and they're going to VC and private equity. Whereas like corporate pensions going to more fixed income is like, what do you think? There's going to be deflation, like with the Fed printing Fed and fiscal printing $12.3 trillion. Like, I don't know, the value proposition of putting more money in fixed income seems kind of dumb to me. But the one thing I'll say is like watching mega institutions operate, nothing makes sense. They go to these consultants. The consultants say I should allocate money here, and then you watch it happen, and you're like, why do you listen to consultants? Like investing should not be about following the herd. Like in so I think this is going to be a contraindicator where, if you look at that chart, they were investing way more in equity like in 2006, right before the bubble burst. And this could be the ultimate irony where they're putting money in bonds just as it's bursting, in 2021.
Well,
Because inflation's picking up. Like, there's no and ifs or buts about that. Like, if you tell me that inflation is not here, like, I don't know, you must be smoking something.
give me some. I'll have what he's having.
Yeah, exactly.
It's funny. You know what consultants are, right?
This is going to be a consultant.
They're just an insurance policy. That's what consultants are.
Exactly.
So I used to be a consultant, and I get there's a big difference between the type of consulting that I was doing and what these investment consultants do. But I mean, it's the same basic principle. It's like, think about the incentives when you get brought in as a consultant, right? There's like a VP of sales or purchasing or supply chain or whatever, and this person understands what the problem is in their business. It's ludicrous to think that you're going to come. And by the way, when you hire a consultant, it's not the partner doing the work that's closing the deal. It's the 23-year-old overworked analyst who's got like 1 year of experience, and is like furiously trying to figure shit out on Excel, and is has no idea what your business is or what they do, anything like that. So really, the value add of someone bringing in an outside consultant is they already have an idea. They want to get it validated in a big stamp of approval, so they can point to whoever they need to secure internal buy-in and say the consultant said that we should do this. And your job as a consultant is to take what the person who hired you wants the conclusion to be, and then make the data fit. So that is your job as a consultant, and you are
great incentives.
Excellent incentives. Yeah,
it reminds me of like Moody's and S&P and Fitch in bond ratings. It's like, you get paid by all these firms to rate their bonds. It's like, hey, make the numbers work.
Make the numbers work. Yeah. Others are going to take it down the street. Last thing on this. Talking about public pension plans or public pensions moving to other asset classes, there's a lot of talk. Have you heard anything about them buying up like residential real estate, essentially, and literally just bidding on groups of homes?
I think Blackstone does a big chunk of that. Who else? There's Amherst does a big chunk of that. And what's so fascinating to me is like the longer you just give, if the Fed's buying $40 billion mortgage-backed securities a month, it just gives more fuel to that giant institution fire. It keeps the spigots open for them to just keep levering up.
I mean, though, come on. There's a huge difference in between big institutional investors just taking speculative bets on stuff. Houses are things that people use, man. This isn't a piece of paper that you're speculating on whether it's going to go up or down. That's the price of a home. People need to live in something. We live in a physical world. This is more than just an asset. So, I get where they're coming from, but also, I don't know. That seems like dangerous ground for me. If, like me, you think that the number one issue that should be at the forefront of every policymaker's mind is income inequality, if pensions start bidding, like getting in a bidding war with like mom and pop people who are just trying to afford a home, that's a bad scenario, I think.
Yeah.
One
of the guys that responded to my Twitter when I put out that tweet that kind of went a little bit viral on
your tweets are ripping. Your tweets are ripping, man. My Twitter grows by I get like 5 new followers a week. I think you're catching up to me already.
Yeah, it's hard doing it. It's the people that do it a lot. I'm like, what do you do all day? It's really hard to do. Like, do they pay someone to do it? Like, there's a return on it. But
search me, man. I don't know.
Besides the point, what's funny is this one guy just hits me. He had like 50 followers or something. He's like, the irony about this is if public pensions are supposed to help the little guy, but like they really do the opposite in a lot of senses. Is they just make things more expensive for the people they're trying to help. And I think that's my biggest qualm with like these giant institutions that keep growing and growing and growing. It's like festering growth that has good intentions and then ends up like screwing over the people they're trying to help. It's like America
agree.
In a nutshell.
Yeah, it's a big problem. We got to figure out a way to solve it. I have no idea. I actually think one issue that doesn't get brought up enough is just antitrust.
Bitcoin.
Okay, cool. Let's get on to the next topic here. I want to talk about Nexon and their purchase of 100 million in Bitcoin. I'll just kind of set the scene here. I know you wrote a great newsletter on this, actually, so I want to give you the chance to kind of explain your take on it. But just to kind of set the scene, so Nexon, they're a company that was originally founded in South Korea. They're now Tokyo based, and they're a video game publisher. They specialize in online games for PC and mobile. It's actually the largest game company in South Korea, where I think they're still headquartered, and the third largest in Asia overall. They're only behind Tencent and NetEase. So basically, this is a really big company. They have a market cap of about 30 billion, and they're a top 30 holding in the Nikkei. So it's a large company. The $100 million represented about 2% of the company's overall cash reserves. Tyler, you wrote a great piece on this. So why is this something that we should be paying attention to?
I just think it's a geographically diverse company. I think it's based in Japan, but it's a South Korean company.
Yeah.
They moved their headquarters there. And they are $30 billion. Like MicroStrategy is a $6 billion company. They're a $30 billion company. They're leading like futuristic stuff. They're already in, the meta world. And this guy just said, very matter of factly, I can't hold bonds on my balance sheet anymore, which is basically what all these cash rich companies do is they go and buy bonds as like a, savings account. And that's what their corporate treasurers do. And you can't buy Bitcoin all at once, right? You need to dip your toe in and then say, okay, like if you bought $5 billion, which was their cash reserves all at once, that would raise a red flag for like governments to be like, holy shit, right? But he bought 2% of his reserves. And I think that's sort of what's happening globally is all these corporations are like, well, we're not getting any clarity. They keep juicing this thing in every jurisdiction. Like, look at the balance sheets. Every balance sheet of the major developed countries is going parabolic. And I think this is a super smart move by this guy. Big props to him. And, the way they write about it is so articulate. Like, he calls bonds rewardless risk, just like Diego Perea, right?
Yeah, just like Paul Singer.
Yeah, and that ethos, it's like a 40-year bull market you're trying to break, and you can kind of see it coming apart, like slowly. And when you see it from the corporate level, it's actually pretty scary, right? Because this could cause like a massive, like if you're looking for that next ramp up in Bitcoin, it's a lot of money,
Yeah.
This guy's sitting on $5 billion of cash. Do that globally. Do that geographically. That's a lot of money that could come in.
Yeah.
What's your read on it?
So when Saylor first did his purchase of Bitcoin, I was like, I don't understand this at all. That seems reckless to me. It seems really speculative. I think my take now, watching companies do what they're doing, Michael Mora went on Jason's show earlier this week, and he announced that $8 billion of Bitcoin had been bought from corporations through their desk alone in Q1. $8 billion. So if you just look at those numbers, right, there's a lot of announcements, right? There's a lot of Bitcoin on corporate balance sheets that has not been discovered or announced yet necessarily. Yeah. But I think what companies are basically saying is, if you look at the mandate of the Fed right now, there's the dual mandate, right, of price stability and inflation, and then there's also jobs, some unemployment somewhere in there as well. But when you actually get back to what the Federal Reserve and central banks are supposed to do in general, they're supposed to defend the currency. And I think what corporate treasurers are realizing is that central banks around the world are not doing what they were originally set up to do. They are not defending the currency. They are actually doing the exact opposite. They are debasing the currency. And I think it took me a while to wrap my head around this, but I think corporate treasurers have basically said, if you guys aren't going to do your job, we're going to take this into our own hands and we're going to do it for ourselves. Because at a certain point, this just doesn't make any sense for us anymore. And I think overall, I don't know. I think it still is a little bit dangerous, to be totally honest, because, when you think about how institutions are going to react to an asset class that's this volatile, there's this narrative that institutions are going to be better than retail when it comes to holding through intense periods of volatility. I don't think so. I don't think so at all. I think a lot of these institutions, the amount of conviction in this asset has not been beaten into you yet. And if there were a 50% drawdown, I think the institutions would be at the first of the line selling, basically. So, yeah, I think it's I don't think I think you're going to see a lot of companies and large asset managers essentially top tick, and then they're going to sell. Um, that's what I think is going to end up happening. So
Yeah, I don't know. I take the opposite side of that trade because if it's only
okay,
2% of your assets, then like okay, you can say okay, we tried that. You know, maybe they sell it, but I think the downside for them is relatively negligible. But as they ramp up, I think it'll cause them to ramp up. You know, because it's only a tiny allocation.
yeah, you might be right.
Here's a thought I just had while you were speaking, which is think about this. In a globalized world, like super high globalized world, that basically you need a middle class to work, right?
Right.
From all different countries. And I think we're at the end of like hollowing out the middle class. And now all these central banks need to print money to paper over all their debts.
Right.
And what the irony is like maximum employment and all that is they're basically playing a game against each other where the more they print money they're like hollowing at the middle class even more. And just because the USD JPY doesn't kind of move in lockstep doesn't mean that that effect isn't felt by the middle class. It is in the housing costs, it's in the lumber, it's in the wheat and the corn, and so what you're really seeing is like the workers of these giant globalized corporations are like, you need to pay me more because, and the companies are like, well, shit, like we're not growing fast enough our earnings, so we need to put, and we can't invest in bonds at a rate that will grow at like the wage growth. So
Yeah.
they need an asset that has that payout, and I think that's Bitcoin. I think that's really what's going on.
I think you're totally right. The story of crypto and Bitcoin in general is a story about growth. That at the very, if you trace everything back, the problem is that there's no growth. And the reason why central banks essentially have to print they have to do what they're doing is because the amount that they print is directly in relation to how short we are in terms of our obligations versus the expected rate of growth, right? Because as long as we're not growing enough to essentially pay for progress and cover our own obligations, especially with the debt load that we have, the central banks have to essentially make up the difference. So I don't know how to fix that, really. I think that's why crypto is so interesting in general. I think it's something that every country is going to need to at least understand because crypto is inherently borderless. The structure of it, these decentralized networks, that's kind of a core key feature. And there are a lot of detractors out there who say, well, that's why it's never going to work. But I think it's the opposite of that. I think it's Uber. And I think it's going to work. And because there's going to be so much growth and so many jobs are going to be created, so much wealth is going to be created, governments need to figure out how to make that work. And the ones
Speaking of which, I think the German stuff is really super fascinating. And
yeah,
you want to go into that?
Yeah, let's get into that. So Germany has opened itself up some institutional funds to crypto. So new legislation enables about 4,000. I'm going to butcher the pronunciation here. Spezial funds, I think.
Are you
Spezial?
German? You got a perfect accent.
Spezial fund. I was Italian. I'm Italian. To invest in crypto assets, and this becomes law in Germany on July 1st. So the legislation will allow popular institutional investment funds, which are these Spezial funds. God, that's like a joke. I'm just going to call them the funds, all right, for the purposes of this. Then they're allowed to allocate up to 20% in crypto. This is actually pretty big in terms of scale here. There's about 1.8 trillion right now invested in these funds. So you have a really small allocation of, let's say, 2% of those funds. That could be up to $40 billion worth of capital entering crypto.
And if rates are negative in Europe, why is it only 2? It could be 20. It could be the 20%, which is 400.
It could be. Yeah, absolutely.
So, I don't know.
I think it's really interesting. The framework that I have now for Bitcoin is, if Bitcoin is ever going to be a real monetary reserve asset, what's going to take it to where it needs to be is not retail, it is institutional. And the way I kind of think about it now is the larger Bitcoin gets as a function of its price, almost like the more demand it's going to unlock. because the larger of an asset class it is, the less risk there's perceived to be, and the more institutions will be allowed to invest in it as per their mandate. So it's almost like as Bitcoin is like growing and growing and growing, it's not, it's actually unlocking new sources of demand as it grows, right? It's a really weird dynamic in that way. And, you know, and the supply characteristic of it as well, it is the only asset in the world, commodities included, gold included, steel included, whatever pick your commodity, that there's no supply adjustment relative to demand.
Yeah.
It's I know that's been articulated a lot, but like, you know, you see these little facts and no one was like, oh man, can't wait till these German funds come in, and it's just like casual 1.8 trillion that can now be invested in crypto. It's pretty amazing.
This too also opens up like you know how Ireland lowered their corporate tax to like 20%, and that caused a lot of like these companies to relocate to Ireland, their home base, right? I think this is sort of a version of that for crypto, where it creates this like regulatory arbitrage thing where it's like, crap, you know, like Germany just opened this up for their special funds, and like we have to do
That
it
has a
too.
little hint of Spanish on it, especially.
They're a first, you know, the German culture is an interesting one because obviously they're afraid of debt, right? And I think they hate being tied to, you know, the rest of Europe, who kind of like is ramping up their debt spending, and this might be a way for them to hedge out the exposure in like a, you know, Hayek type Austrian economics asset, where it balances out their Keynesian, you know, Euro project, which, you know what, but then that causes all these knock-on effects because they are one of the biggest economies in the world. They're big exporter, right? So this is such understated news, and
I agree.
especially, you know, with rates not moving there, like they're not stopping the QE over the ECB. So I don't know. I think it's a big one and could cause some major knock-on effects. We'll see what happens up to July 1st, because I bet that becomes a story like, hey, this big influx, 400 billion of potential capital can move in. We'll see.
There's an analogy that gets tossed around in crypto, basically being musical chairs. And there is a really important game theory aspect of crypto adoption in governments because, you know, on the one hand, it is very possible that the US could come out tomorrow and say, hey, it's illegal to own Bitcoin. Or they could attack kind of the on-ramps, right, via exchanges and wallets. But if you legislate too hard, then you essentially lose your seat at the table. And if it becomes dominant, then you've really done yourself a huge disservice. And I actually think that's the reason why there hasn't been harsher legislation. And if you want to kind of put your tinfoil hat on a little bit, you know, China kind of recently came out and changed its stance on Bitcoin and crypto. They actually were very harsh in terms of regulating the crypto industry over there. And they've now called Bitcoin an alternative investment, right, which is a very different stance than they used to. If you look at just this within the context of the monetary system in general, China is trying to move off of a dollar standard. They hate that the US dollar is at the center of the monetary system. If you look at a country like Germany, who's their biggest trade partner? It's China.
Sure.
So if you want to put your tinfoil hat on, you could say maybe China is beginning to exert its influence as the dominant trade partner of virtually like every country in the world at this point. And I think it comes down to this question of who benefits the most from this. Is it China or is it the US? Because that's a really big question to ask, I think, that a lot of people don't in crypto. And you have to be, because it's an important question.
That's the Peter Thiel question, and you know,
the Peter Thiel
I guess
question.
we'll find out. But I don't know. It would be interesting if the U.S. kind of chased this and was just like, you know what, we're opening it up. And you see the policymakers are making jumps into the U.S. crypto company management, which is, I think it's a good sign. And I'm just hoping they move fast enough where, you know, we can take advantage of it.
Totally.
One other thing that I thought of, and I put this quote in my note yesterday, but it's from a German sociologist named Ulrich Beck. He said, "I forced to think to myself, what is the new concept? And it became clear to me that it was risk, not only in technology and ecology, but in life and employment too. And I think that really synopsizes what point in history we're at, which is the avoidance of risk has been the predominant theme in, I don't know, the past 30 years. It's why the supply of new ideas is so small and growth is so small, is because everyone thought they could just, you know, go with the crowd and just keep up with this demographic boom. And now that the demographic boom is rolling over, to actually outgrow anything, you have to embrace risk. You have to embrace volatility. And that is, it's really original. I think that's really what Bitcoin will be
Yeah.
for a lot of these giant institutions and countries. Countries basically they want to be short vol naturally. So the first movers like Germany doing this into a long vol decentralized world, they will get the benefit of it before everybody else. So we'll see how the dominoes fall from here.
I agree. I think that's actually probably the most underdiscussed but most important dynamic to understand is that the whole world is moving long ball, whether or not they want to. And it's been central bank policy essentially for the last 20 or 30 years to try to repress volatility, but it's cropping up in other places outside of even financial markets. If you think about what was the driving force that got Trump elected, no comment on his politics here, but it was a long vol trade because essentially if you a vote for Trump is I am not happy with the current system. And when he was getting elected, there were a lot of questions like, what's this guy actually going to be like? He was saying a lot of outlandish things. He's doing a lot of outlandish things when it comes to, politics as usual in America. Let's give it a shot, right? It's going to be different. Let's take a stab. See what it's like. So Trump is long vol. Crypto is long vol. Options, GameStop, all that stuff. It's all the same side. It's all manifesting itself in different ways, but it's all people not happy with the status quo. And when you have a lot of people that don't see the path, then they go long volatility because what's the worst that could happen? I could actually achieve a positive outcome. And that's kind of dangerous.
Look at the short vol path for like millennials and Gen Zers. They're saddled in, student loans. They can't keep up with the inflation. Their wages aren't going, up commensurately to buy homes. They can't procreate because they don't want to get into relationships. They work so hard, and I think that's the short vol game that everyone was sold for years and years.
Yeah,
and the people are kind of just saying, you know what, screw it. I'm gonna go to that new company, and my incentives will be way better than if I get paid higher somewhere else. Like at least that thing's growing. It might be riskier, but it's actually growing than this one that's dying, literally. And that's the big arb: short vol to long vol. Be long vol. I think we feel it, and it's more exciting. It's you get wins and losses instead of just like slow death by 1,000 cuts.
Totally. I agree. I think even operating in the reason. I think you actually might be right. I'll revise my statement maybe on what I was saying about corporate selling, but I'll just say like from personal experience, this is my second cycle in crypto, and as much as I believed in it, I don't think it took me to be in multiple cycles to have the amount of conviction that I currently do. It's hard because it's just an emotionally difficult thing. There's one thing to say you understand it and to conceptually understand it. Then there's another thing to have lived experience and really feel it. It's a difference.
Well, we could be having a different conversation in a month if all of a sudden Jay Powell says, hey, we're going to be tapering assets. And that's really what was going on behind the scenes when the bubble burst in like 2017, 2018. They were shrinking the balance sheet. They were tightening monetary policy, and that caused like a lot of global deflationary pressures. And I think right now, the one thing that we had the pandemic, they blew out all the balance sheets, and now the deficits are way too big that they can't stop. That's the big difference now. It's like you need financing costs to remain very low for the federal government, and that's the scary thing. right now. Is you have inflation picking up, the financing costs have to stay low, so that fiat money printing thing is just going to go in overdrive, I think. But we'll see.
Yeah. It's just funny. At one point, even 10 years ago, if you had said that, the 10-year would be below 2%, you would have said, no, that's no way. But now the 2-year is below it, and it is flirting with 2% again, and it's like the end of the world. Imagine if it went to 4.
Yeah,
It's
that's
like-
because they all levered up when rates fell. Everybody levers up, right, and assumes growth is just going to keep going.
Yeah.
And that's the game we're in. It's Ponzi finance, I think.
Yeah. How much of this can you trace? This is my new little pet theory, but if you look back, it might just be as simple as the demographics from the baby boomer generation and the GI Bill, which was the single biggest transfer of wealth in U.S. history. And for those of you who are not nerds like me and didn't spend a whole night digging through this, there are 3 basic provisions for GIs, which was that you essentially got really cheap access or low rates on mortgages, so really cheap access to residential housing, basically. Actually, a lot of GIs you could basically put no down payment, get access to a mortgage. You had really cheap access to credit if you wanted to start a business, and you had heavily, heavily subsidized education. And it's funny because those are essentially the 3 axes of equality or inequality, right? That's what makes the United States.
This was like the most mind-blowing thing you shared with me last week, where I was like, it really, where are those incentives for our generation?
You don't have those. You do not have them. So, basically you had this whole generation of people that had really cheap access to credit to start a small business. You had really cheap, like the ability to afford a home, which is a huge financial unlock for you as a person. Still, for most people, it's like 80% of your net worth is your home. And then you had cheap access to education. So all of these things, right? And then you had a huge swell of demographics at your back as a huge tailwind. And now look at our generation today, right? Housing is completely unaffordable and getting more unaffordable by the day. College is like, forget about it. Forget this idea of saving for school. It doesn't even make sense anymore. I went to Emory University. Emory University now is $84,000 a year.
Dude, that's
what? Like what?
I mean, it's just stupid. I don't even understand how that works.
I don't even understand how that works either.
The president of that college, you're like, we're ripping. I mean, these kids are just not getting the return.
Like what?
Here's the internet.
And then graduate. And by the way, the average salary is like $50,000.
So bad.
And then actually something that doesn't get talked about either is that banks don't lend to small business anymore. That whole system of funding doesn't work anymore.
And that's the other thing is like back then you didn't have like mega corporations that just ate everything. And like even if we did get financing for a small business, like there's such a bigger barrier to entry now because of those mega corporations. The only reason you guys could do this at Blockworks is like a media company is the easiest thing to start with because it's very low cost. It doesn't cost this much to do.
There's no capital expense, really.
Exactly. And so you just need to say some really original crap to actually grow, which fortunately I think we're doing. But like, back then if you got a loan, you could start a business and you could be an entrepreneur way easier than you can today. So I just think it's a policy thing. And once you have a change in the gerontocracy, they'll really start incentivizing things for the next generation.
Totally. So there's the Warren Buffett saying about bubbles where it's like at the heart of every bubble was a great idea that people took to excess. And I haven't done the work enough yet, but if you look at, they had it figured out back then. What are the things that people need to move their lives ahead? It's access to credit, it's access to education, and it's a home. A home is part of the social contract of being an American. It's the single biggest asset that the vast majority of people in this country have access to. And you as a young person, you do not have access anymore to any of those things readily. If you come from a background of privilege, then you do. But if you don't, it is harder and harder and harder to get access to those things. And it's
Yeah,
a problem.
riskier
Yeah.
and riskier bets, right?
Yeah.
And I think that's why you see these crazy narratives. Like they're trying to stew it on the monetary policies part. You have these crazy companies that come and they're like, you get the Elizabeth Holmes type people, and the every SPAC is going 5 years out and giving you these outrageous expectations that never come to fruition. And that's really what you get is a bunch of narrative spinners instead of like people that want to make good long-term businesses. And you get the sociopaths that race for free capital and try and create stuff.
Yeah.
Some do, and it's great,
Yeah.
but the majority I don't think do. I think 90% fail.
There's a reflexive property when it comes to different sources of funding. So if you think about the funding that was available to small business entrepreneurs back in the 60s and 70s, that was banks, right? And the banking model was different then. Now you have these huge, giant, consolidated behemoth, JP Morgan Chase type banks. You used to have a model of small, like local and regional banks, right? And they would lend to entrepreneurs. Now that doesn't exist anymore. And if you're an entrepreneur looking for capital, you pretty much have to go to VCs. And VCs, to make their business model work, they need these big moonshots, right?
Yeah.
So the funding, everything is aligned to produce these like high flying, super risky tech companies. And I don't know, it's like what came first, the chicken or the egg? Was it the low interest rates that made these tech companies do well, and then the funding sources, kind of fit that mold? Was it the other way around, and actually, small local regional banking like went away? So then the only funding sources that were available were these like VC. I don't know, like what happened? Who knows? I don't know. It's a lot of factors, but it all did happen, and
Yeah.
that's where we're at.
And you know what's even more fascinating? And this is like banking 3, maybe 4.0, but this is just a new thought, so it could be complete nonsense. But
All right,
I saw Shopify today is now becoming a lender to specific retail businesses and
yeah.
e-commerce, which kind of upends like banks. Like if you're a specialty, Shopify gets data from all these people. And if they can basically monetize their lending, that just is just boom, mind blowing. Then every single like person that has like Mark Zuckerberg could be a credit card company where he knows all your data, and he knows everything you're doing and everything you're spending, and like he can basically say here's a loan because I know everything about you. Right? He can do it better than Wells Fargo can.
Yeah.
Right?
Yeah.
Like
Yeah.
that's some crazy stuff right there. I mean,
Yeah.
Larry Page and Sergey Brin know our Google history. Like they can basically be like, all right, this guy's gonna go spend on a dumb car that's like $80,000. I don't know. We're getting out into la la land, but
No, but this is already happening. I actually noticed this a little while ago because the payment infrastructure. So we interface with QuickBooks. Guess what? Intuit QuickBooks, they're also starting to offer working capital loans. What's the other one that would like Stripe? There's Stripe Capital now, and they also offer working capital loans. PayPal also offers loans, and I've actually been surprised. Like just like you said, that social media companies haven't done it. It's like how could you could underwrite that risk so much more? What if TikTok tried to do it? They've got these people that are earning millions of dollars as creators. Imagine the loans. Imagine how accurately you could underwrite that risk. They famously collect like 1,200 data points or something on each person. Be nuts, man. You could do, fascinating.
yeah,
Fascinating.
that's a we got to find someone who can speak to that a little bit.
There's who first flagged this was his name's Ali Hamed, CoVenture, and they fund companies that have these kind of funky debt products. I'm calling them funky. It's probably gonna be standard in like 10 years in the bank. But he's really smart on this. Yeah, we should talk to him.
I mean, if you go 30,000 foot view, what we're really talking about is just like money is now it's so easy to come by that maybe you should lever up, a gazillion times and just buy like finite supply of things like a TikTok star that's very original. Like we're really getting into a world of like when fiat is so pervasive and easy to come by, and you can basically borrow money at nothing and lend, and your balance sheet just gets bigger and bigger and bigger as a company, and there's no tightening of policy.
So I have I've got an anti-inflation argument for you here, and it actually comes from synthesizing two, there's Lacey Hunt, and then there's Mike Green, and they say two very different things. So Mike Green's definition of money is that which extinguishes debt, right? You said there's a lot of money in the world, there's a lot of credit in the world, which is slightly different. Mm-hmm. And Lacey Hunt's whole thing is that the more debt that you have, the more of an overhang it is. And actually there's a certain amount of your income that essentially needs to go to paying down that debt. So debt is inherently deflationary. And I wonder if at this point, what the Federal Reserve and the government has essentially seen is we have so much debt in the world that if you view money, real money, as that which extinguishes or eliminates debt, then you could print so much more money. Because like all else being equal, it's like 38 cents of every dollar earned right now is going to paying down debt in America. Mm-hmm. So essentially you could print 38%, and as I'm saying this, didn't they print 40% of the money supply? Wasn't that the number? So you can essentially get away with that scot-free, right? Right there. You're just plugging the hole basically from the debt that exists. So you kind of want more money creation actually, because you're not starting from square one. You're starting from square like negative 20.
Yeah, we're getting into dystopian land, but
it's weird.
It's true. I mean, I guess I follow that logic. Is more debt's deflationary, and totally get it. But will that money find its way into producing more commodities so that the middle class and the labor pool doesn't have their margins get squished? Because that's when you get the revolts. You get they can't pay. When the middle class can't pay their debts, you get the subprime crises, you get the euro, crises, and you get the Arab Spring. And that's we're edging towards that world as you see the commodity inflation go up.
Yeah.
And people are paying attention now, I think.
You know what, dude? You might never see CPI move 1 inch, and it might not even matter. Might not matter, because we just talked about like what are the things that people really need to spend money on. You need education, access to credit. I'm blanking on the last one. I forget. Housing. As long as the price of those things are becoming unaffordable or not within reach, maybe that's all it takes. Maybe we'll never even see CPI inflation, but it doesn't matter because the income inequality thing reaches a breaking point before we ever quote unquote recognize inflation.
Yeah. I don't know. You gave me a lot to think about this weekend.
We'll be chatting. I'm not doing anything. Yeah. One more thing to end here, and I want to actually bring this up because I think it's kind of interesting. So a lot of focus on ETH, right? ETH outpacing BTC, although that actually might have reversed today. We're recording on Friday. So if I'm looking at prices right now, it's actually reversed a little bit. Yeah, Bitcoin's up like 8% in the last 24 hours, which is not bad. But, ETH had been outperforming, and there was one day when it was like stock market was down, Bitcoin was down, ETH and alts were up. And one thing, Bitcoin has always been kind of touted as this uncorrelated asset, which maybe it is. Maybe it's less core. But as Bitcoin becomes more and more of an institutional asset and has a more and more institutional holder base, then and also as leverage is applied to it, then I would imagine that correlation to other asset classes has to go up. But some of these alts, like institutions aren't buying altcoins, I mean. So they actually might be the last bastion of that real uncorrelated stuff. I don't know.
Yeah.
It's a theory.
No, I'm with you. Junaid over at Pareto, he has this thing called Manifold, and I got a sample of it, and he shows that alts are super non-correlated to any other asset. And this is what's a really fascinating thought is like, if you are already inherently wealthy as like a digital currency developer, right? Yeah. And you're like, holy crap, here's this really cool project that I'm going to work on that's like, micro cap.
Right.
And you get a lot of that value by working on it. And you're like, well, I'm just going to hold this because I'm already like super wealthy over here.
Yep.
And your holder base is stronger at a lower if you have really good developers, right? And so when you see the macro things like big, drawdowns in like, asset equities and bonds, these can actually perform really, really well because they're just like a very idiosyncratic holder base that's like non-correlated to anything else.
Yeah.
And I thought that was like super, super fascinating because it's everything that public long short managers and all these other people want, but they can't really do compliance wise. So
You know what's funny about this as well is, an outsider's take on, I have, again, no background in finance, but so sometimes when I'm looking at how things work in financial markets, I'm like, why does it work like this? And one thing that, from an outsider's perspective, it looks like there are all these correlations that it doesn't even really make sense that certain things behave in the way they do, but it's just, there are these beliefs that have been reinforced and reinforced and reinforced. And at this point, when you see something, you're like, oh, well, the last time this happened, this other thing happened. And therefore, everyone just anticipates that it's going to happen again. And these relationships get formed, right? Kind of like inverse relationship between the price of bonds and stocks. When there's not really a great reason for that to happen, but it just gets reinforced and reinforced in these. And it actually, belief impacts outcomes. And those haven't really been formed yet in crypto, which makes it so interesting. Those things are getting formed as we speak today. I mean,
well, I think that's what happens when you have these world controllers. It's like the Brave New World type stuff where in the public equity market, like there's no reason, like when they're in the same indices and capital just goes in, say you put, $1 billion into an ETF and like they all move up together, they all move down together when there's inflows and outflows and there's no like differentiation between the companies. And that shouldn't be the case.
Yeah.
You should have a little personality, and maybe it's, art mimics life, life mimics art, because like the internet allowed the centralization of capital, the centralization of thought, like media, like you watch mainstream media all the time, and it's just like they're like world controllers. Like they don't let you think other stuff, and I think that growth went like this, parabolic, and now we're seeing people going to like alternative things like altcoins and Blockworks as a form of media that's like, so you can't say what we say on those things. You can't manage money the same way you can in public equities as you can in digital assets. So like by nature, I think that is the next big secular push. Right? Am I going down some crazy?
No, you're not. No, you're not. And the money manager thing, I actually think, I think a lot of legacy finance is not going to be able to make the transition into crypto. There's a great podcast. There's a great podcast called Up Only. I just started listening to it, and one thing that I didn't fully appreciate until recently is a lot of these like accounts that you see on Twitter, these kind of shit posting, weird name, talk about. There are real people behind those accounts moving real money, 9-figure, like real money. And they're essentially prop trading. And when you look at who is successful in this market, I think you're literally watching the next generation of great macro funds getting built before our eyes. Like it's hard. So when you think of a guy like Paul Tudor Jones or someone like that, you think storied investor, right? You're like, that guy, he is synonymous with, he's an institution unto himself. But it wasn't always like that. And when you actually trace back the history of hedge funds, some of those really early hedge funds, nobody knew what the fuck they did. And they were like nerdy guys like working on these formulas and like low key just printing money, right? Like if you take it all the way back to like Commodities Corporation, Bruce Kovner.
Yeah.
Read Market Wizards. Everyone should read Market Wizards. But you gotta think what it was actually like back then. And I think we're watching those people get built before our eyes. And
look at Travis Kling. I read his tweets sometimes, and I'm like, he just calls it like it is, and you would never be able, he was ex Goldman guy, and like everything he says, I kind of just agree with.
Yeah, me too.
But it's such an anti-consensus thing to say, and in that it's really hard for people to do that come from that world because you get like lambasted. It's like, oh, he's a crazy crypto guy, you know. But he's printing money right now, and no one and everyone over here is like, you know, making less every year, and he's just like probably just gathering assets, and his performance is skyrocketing, and like, but it's not like it had that tipping point. I think we're right on where it becomes okay. These guys are going to be like the new legends, like Sam Bankman-Fried's, you know, creating like new models in a whole new world.
I don't think people understand the scale that crypto hedge funds are growing at right now. And when I mean growing, I mean there were some funds that, you know, without naming any names or doxing, but there were some funds that started out in 2018 with, you know, sometimes sub like 7 figures of AUM that have now crossed the $1 billion mark. I mean, we are talking 100x AUM growth over a span of 2.5 years. It is,
And they're charging like 2 and 30 or something like that. It's
probably
like,
more. I don't know.
yeah.
Huge minimums now. I mean, I mean, the money that is being made, and it's pretty incredible. I don't think people have fully grasped it, and I think a lot of people in crypto are happy to let them not grasp it, right? Because why would they want the competition, right?
Yeah. And it's a harder barrier to entry. It's not like you can just be a hedge fund in the public markets now, and then all of a sudden you need custody. You need like it's a whole new technology. I get nervous, you know, transferring money from here to there using wallets and stuff. And you know, I've been doing it for a couple of years.
Yeah.
But and speaking of which, not to drag this on too long, but recently I just took out a loan against my, you know, assets at BlockFi.
Interesting.
And like I can't stress this enough. If you haven't done this, just do a small amount just to borrow against. And it is so much better than working with a bank. I just refinanced my house a couple months ago. That was like full cavity search. I just took out in like under 10 minutes, you take out a loan against your collateral. You post collateral, so it's basically like you're posting your house against collateral for mortgage, and you get money in your account within like 10 minutes. And like you can't this is banking, and you can't do this. Like Wells Fargo could not do this if they tried.
Okay. You're so right. You know, one thing just hit me. This was a minor moment from a webinar that we did earlier this week, but we had these people on, and they were talking about how now when you have to use a bank to send a wire, it's like annoying. It feels like you're dialing into the internet using dial-up. And I get it, because once you actually get your hands on... So, okay. Once you actually get your hands on this stuff, it feels like you're taking huge steps backwards using the legacy stuff.
Yeah.
And, you know, so Grant Williams came on this podcast like a month ago. It was awesome. He was super generous this time. Awesome guy. It is so funny to hear. You know, he had this line that really stuck with me, which was, he was like, the first time I bought gold, I'll never forget it. It was solid. I felt it in my hand. There was this visceral experience that like made a mark on him. And that's exactly how I feel about Bitcoin. When you first use this technology and you just put an address in, you send it, and it works, it's incredible. It's like...
For a negligible fee.
For negligible fee. Yeah. And as someone who like, I live in our, you know, we bank with one of those huge banks, and
so I just...
Franco, if you're listening, you do a great job, man. But like, you know, I've always calls, the payments are always getting held up. It's like I'm on the phone with these people all the time.
Yeah.
And even just how clunky the interface feels as well. It's like you are designing this to make this more difficult for me. It is I can't find it. It sucks.
Here's a tiny last thing is, so I bought Stacks, right? STX. And I know
You know, we're not sponsored by any of these things.
No,
we got all these
no.
books.
I mean,
BlockFi Stacks.
But so I took like 3 days to get my money into like Coinbase, and then I transferred from Coinbase. Once it was in Coinbase, you can only buy Stacks on like OKCoin in the US, and so you got my app open on OKCoin, on my phone within like 3 minutes, transferred. Once the money was in Coinbase, transfer the money from Coinbase to OKCoin. It gets there, you can buy the stacks. And like, just to get the money into the digital asset ecosystem was the hardest part. And then from there, it's just like bing, 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 bing.
Yeah.
And I mean, it really is mind blowing. And to think that like you can do that anywhere in the world that's the instant value prop right there. It's like I could be in Tokyo, I could be in, Indonesia and do the same exact thing just with an internet connection.
Yeah. It's if you've ever had to send, if anyone listening to this has ever had to send an international wire transfer, you will know the acute pain of what that process is actually like. And I would even say at the current state of infrastructure, crypto is a full order of magnitude better as a product sending money than the current system. That's everything included. That's, you can't do clawbacks, right? If you send it to the wrong, whatever, like all factors being included, the current product set or suite of offerings essentially within crypto is an order of magnitude better than the legacy banking system in my having used it actually, just in my opinion, but like having used both extensively, I would say so. It's cool.
Well,
all right, man.
this was brought to you by Bitcoin.
Yeah, me and the CEO of Bitcoin, we're tight. We go way back.
What a guy.
Great guy. Or gal. Who knows? What are your plans this weekend? What are you getting up to?
We were going to go. They have all these outdoor breweries in Texas that are like huge monster areas because everything's bigger in Texas, but it's looking like there's a stream in my front yard. It's about to downpour. So hopefully it subsides and we can go.
It just started like hurricane raining. In New York. That's where I am right now. So
when do you think movies are coming back? Movie theaters.
Oh man, I hope they do. Well, actually, what is it even like? There haven't been very many good movies in 2020 or 2020. Yeah, because all the production stopped essentially. I miss movies. I love movies. I'm a big movie guy, big TV guy. I like the stories. They speak. I'm a story guy.
You are.
I love the pods. I love the movies. I love the TV. I need it.
Have you seen City of Lies? It's the story of like Biggie getting killed and how like the LA cops.
That's a watch.
Johnny Depp, Forrest Whitaker.
Is this new Johnny Depp though, or old Johnny Depp?
Yeah, I think this was in the last year. It was new.
Johnny Depp, man. I don't want to kick a guy when he's down, but man, that guy's had a bit of a fall from grace. I will say that about our boy Johnny. There was a Rolling Stones article on him, like an expose. Did you read that? Came out like a year and a half ago.
No, I missed it.
He'll be okay. He's got like hundreds of millions of dollars. But all right, that's a good watch. I'm trying to think. I don't know if I want to admit this on air. I've never seen the OC, and I like watched the full first season of the OC over the last month, and that is a meaty first season.
Bitter Valley Girl.
Yeah, seriously. Like, what am I doing? But I just never seen it, and like one night I just turned it on, and
doesn't it make you want to move there though?
Yeah, it does. I knew a girl in college that was from there, Newport or whatever. But I was just like, damn, this does look good. It's a meaty first season. It's 27 episodes, 45 minutes each.
Oh, wow.
It's like a time investment.
Dude, what are you doing with your time? You're supposed to be the CEO, bro.
Yeah. It's on weekends, nights and weekends. Gotcha. Literally cranked through.
That's right.
Yeah, cranked through the whole first season of the OC. And I got to tell you, it's not I got to leave it. I'm not going to continue. I'm not going to.
I barely remember it.
Yeah, I know. It's like, it's very similar to, it reminds me like a Gossip Girl kind of thing. It's just, it's CW teen drama.
I liked One Tree Hill.
Really? I never watched. You'd give it a
One Tree.
One Tree. All right, cool. All right, well, we'll have to curate a more specific list of teen dramas for everyone last time. I'm sure there's a lot of overlap between our audience and that kind of stuff. But all right, man. Have a good weekend. I'll see you same time next week. Take care,
bro. That's it.
All right.